Greetings everyone, I'm Michael and this is Credit Kuri, where we talk about credit, finance, and investments. In today's video, we're going to talk about the most common misconceptions about your credit score. You probably already know that you need a good credit score to get the best interest rates on a mortgage or auto loan, which can make a big difference to your budget over time. With something like a mortgage, even a minor difference in rates can have a big impact on your monthly payments and can mean tens of thousands of dollars or more over the life of the loan. But that's just the beginning of how the three-digit number impacts your financial life. Your credit score, a rating of your credit worthiness, can also affect the rates that you pay for insurance, your cell phone plan, and even your ability to land certain types of jobs. But despite the importance of credit scores, they remain widely misunderstood. Here's a look at several common misconceptions. Number 1, carrying a balance will improve score. Nearly 60% of consumers believe this myth, according to a recent survey by the U.S. News and World Report. One of the main factors in determining your credit score is your credit utilization ratio, or the percentage of your available credit that you're using at any given time. The lower the number, the better, but aim to keep it under 30%. You don't want to carry a balance because it just pushes up your utilization ratio. Number 2, there's only one credit score. While FICO is the most popular score provider, different types of lenders use different versions of the score. Plus, a growing number of lenders work with FICO's competitors, such as VantageScore. There are many different credit scores out there, and the score you just saw might not be the same one a lender sees when they're examining your credit worthiness. Even if the scores are slightly different, they should tread in the same direction. So if one score drops significantly and the other does not, that could indicate a mistake or other issues in one of your credit reports. Number 3, it costs money to check your credit. You can get your credit report from the 3 major credit agencies, Equifax, Experian, and TransUnion, every week for free at annualcreditreport.com. Most experts suggest checking your credit at least once per year to look for errors or evidence of identity theft, and federal law requires that the agencies allow you to do so for free. The credit agencies began offering weekly access to reports during the pandemic, but that could end soon. One of the best ways to improve your credit score is to fix mistakes on your credit report. Credit reports do not need to include your score, but you can still get free access to certain scores through websites like LendingTree, Credit Karma, or through your credit card issuer. Number 4, closing old credit cards can boost your score. The length of your credit history is another factor that goes into your credit score. So keeping your older cards open and occasionally using them and paying them off helps rather than hurt your credit score. Number 5, your spouse score can impact yours. Credit scores are for individuals, not couples. While lenders will look at both of your scores if you apply for a joint credit card or mortgage, your scores are separate. So if your spouse has a low score, it won't affect any credit you apply for in your own name. Number 6, opening a new card will hurt your credit. Any new credit, including credit cards, will result in a short-term ding to your credit, but it won't affect your score long-term. It's the hard inquiry that the new lender performs that will likely take a few points from your credit score. But if you have a good credit, it should recover quickly. If you have several years of good credit behind you, you won't need to worry about opening a new card as long as you're not planning to get a mortgage in the next few months. Number 7, co-signing on a loan won't affect your credit. From a credit agency's point of view, co-signing a loan is the same thing as taking out a loan on your own. That loan balance will impact your credit utilization ratio, and late payments will hurt your credit score. If the person you co-sign for is not responsible and does not pay their debt for any reason, that can have a gigantic negative impact on your credit score. That was our video. Do you know of any other misconceptions we may have missed? If so, please leave them in the comments below. Thanks for watching and enjoy your day.